business valuation. It's pretty straightforward, and I'm going to keep it as simple as possible. We have an actual real world business that we are getting ready to list. I've got documents here in front of me that I need. So I'm going to go over a high level how we value and list a business for sale. If any of this goes over your head or starts to feel overwhelming, understandable. It's the first time you're hearing it. Just rewind, listen to it again, call me, let's talk about valuing a business. Historically, people used a calculation of profit. Profit seems simple. You make this, you spend this, you have this much left over, profit. The reason it's not so simple is because you have the IRS and you have a tax return to file. People want to minimize their taxes, business owners especially. One of the main advantages of being self-employed, being a business owner, is being able to shelter income from taxes via legal allowed write-offs. And sometimes people use not legal expenses as write-offs. Doesn't matter. We're not here to audit their taxes, but the effective idea is that if you just looked at a tax return for any given business, you would see, hopefully, an amount of profit. But that doesn't reflect the true cash flow or the owner benefit of owning the business. So let me explain. A business has, let's say, a car, and the owner drives that car to and from work and some other places. If the next person who buys the business elects to not pay for their own vehicle, that is a discretionary expense that the current owner is choosing to pay for out of the business revenue. Another example could be cell phone, a business owner's personal cell phone. Insurance, health insurance, meals and entertainment. So perhaps the owner that's selling really likes to, like I do oftentimes, take agents and so forth to lunch, take my staff to lunch. That's discretionary. My business does not require me to take people to lunch. I might take clients to lunch or coffee. That's my choice. It doesn't show up. It's not like rent or insurance, things that you have to have. So when you visit with your client, your business owner client, you want to have a discussion with them about the documents that you'll need, and then a discussion about how you're going to add back certain expenses, if they exist, to help show a more accurate profit. And you don't want to grill them or act like you're auditing, like you're the IRS. That's not what we're doing. We're simply trying to find out what have they spent money on that they didn't necessarily need to, so that we can show an accurate portrayal of the owner benefit, because we're trying to sell the business, and businesses are supposed to make profit. They're supposed to benefit the owner. Real estate has its own intrinsic value. Even an empty building or an empty house has value. More valuable, generally speaking, if they're making rental income, but they have intrinsic value. The real estate is durable, and all those situs aspects of real estate make it valuable with or without income. But a business is much less valuable, possibly not valuable at all, if it's not making a profit or if it's not benefiting the owner. In that situation, which may come up, where you have a business that wants to sell, needs to sell, and they're not making any money. They might even be losing money. If that is the case, that's called an asset sale. And an asset sale simply means that you're just selling the things and the stuff that the business owns. Everything from furniture, fixtures, equipment, the corporate entity, the name, the goodwill, meaning if they have a list of customers that a new owner could reach out to try and generate more revenue. All of those things are assets that the business owns. Maybe they have vehicles, right? Expensive machinery. You can sell a business as an asset sale when it's not making significant profit. What we're going to talk about today is a business that does have profit, and how, if we can, how can we add back certain items that would show more profit or more benefit to the owner. Now, there are some standard calculations, and these are acronyms. They're described with acronyms. So EBITDA. EBITDA is a bookkeeping term, essentially, and it stands for earnings. Earnings is the same as revenue. It's the top line money that comes into the business. So earnings, the B is before EBITDA, earnings before interest, taxes, EBITDA, depreciation, and amortization, right? Earnings before those items. So that right there is a list of things that you can, generally speaking, add back to the net profit to show EBITDA. That's the earnings before those things. Well, why, Jay? Why would we add those things back? Well, if you think about it, interest, depreciation, amortization, these are things that relate to loans that might have been taken out or equipment that might have been purchased and depreciated over time. They're tax concepts, they're accounting concepts that really kind of sit outside of what a business has to spend. So if I'm buying a business and that business has a loan of, say, $50,000, well, I could assume their loan. That might be part of the deal structure, but generally speaking, I want that $50,000 paid off. I'm just buying the business. I'm not buying their debt, which means if they're paying interest and amortization on that debt of whatever amount, let's just make up a number to say $500 a month. I'm not going to have that same $500 a month. Or maybe they have a company credit card. If that credit card balance is from a previous year where they bought a piece of equipment or had to cover operating expenses, and they're just paying that off, that is a loan. If they're using a credit card every day or weekly to buy stuff in real time for the business, well, that's different. Those are expenses, and those should show up in the profit and loss and expense statements as expenses, like legitimate expenses. We had to buy stuff to be able to sell it, or we had to buy something to run the business. But loans that are not being assumed by the buyer, those payments can be added back to show more profit. Okay. If they bought a vehicle or a large piece of equipment that they are depreciating, or if they own real estate, the business oftentimes own real estate, not always. We can sell whether it owns real estate or not. So these fixed assets, as they're sometimes called, are allowed to be depreciated over time, which means you're writing off a portion of the value of that thing over time, because things don't last forever. So depreciation, if you see that line item, you can add depreciation back to profit. Why? Well, if I buy a business, whatever equipment, vehicles, and real estate that it has that I'm buying, I'm paying for those at the time that I buy it, and I will depreciate those on my taxes, but that's a benefit to me, and it may or may not happen. I may or may not be able to depreciate things. I may have a different way of theory around how I want to depreciate things. So the depreciation on these items it skews the reflection of profit on the profit and loss statement, which is why we add it back. Anything that will be different, potentially different for the buyer that reduces profit can potentially be added back. Okay, so and taxes, okay, is part of that EBITDA. Well, why? Okay, I'm buying a business. My tax situation is going to be different from the seller's tax situation. This is not talking about things like real property taxes. If the business owns real estate, they will be paying property tax and insurance on that real estate. And that's going to continue, and it might even go up, because it generally does go up. We sold a restaurant recently for close to $2 million, and the bulk of the value was in the building. And that building was on the tax rolls for only, I think, $600,000. So eventually the county is going to catch up, and they're going to go, well, this building's worth a lot more. It's traded hands now, and we're going to raise the property taxes. So you wouldn't want to add back property taxes. That's not going to go away unless the buyer of the business is not buying the real estate. And if they aren't, then there's rent. They're going to be paying rent. So either way, they're going to be paying insurance and property taxes, or they're going to be paying rent. That's not the taxes I'm talking about. I'm talking about income, personal income tax, or business income taxes that happen below the profit line, the gross profit line, because those items, generally speaking, are not going to be the same for the buyer. And you'll see some examples of this. So if it doesn't make sense right now, just hang in there with me. It's not that hard, but it'll be, for the visual people like me, you'll see this in black and white here in a minute. But I just need to have this high level discussion. This is a really important point. You need to hear the words that I'm saying so that you can say those to potential clients and help them to understand how, even if they're not showing much profit, this comes up a lot. Hey, yeah, they might even be reluctant to tell you or show you their profit and loss statement. They might have a little shame around that. They might have a little concern that their business isn't worth anything. But if you can tell them, well, look, let's do a little deeper dive and let's see what we can add back. And they may have never heard, even that they might have been in business 20 years, may not have ever heard EBITDA. The next acronym that, in my opinion, is better than EBITDA is SDE, Seller Discretionary Earnings. So EBITDA, if you'll remember, was earnings before these items. Earnings before interest, taxes, depreciation, and amortization. SDE is seller's discretionary earnings. So it would include the EBITDA figures plus anything that they are spending or have spent that year on things that they didn't have to buy, like some of the stuff I mentioned already. And I'll give you a kind of a weird example. I had a seller tell me, well, last year we bought a generator, and it wasn't for the business, it was for the house because a hurricane was coming into town. They just happened to buy that on the business account. I don't care. I'm not the IRS. Again, I'm not their CPA. I don't care if that's a legitimate write-off or not. What I do care, though, is that I don't want a $5,000 generator taking away from their profit, because I want profit to be higher for their sake so that I can value the business at a higher valuation. Because you'll see our valuation is based on a multiple of the cash flow. So if a business is making $100,000 in SDE, and that particular business industry, that type of business, has a multiplier of 3, well, it's very easy math. 300,000 is the value. But if we only look at their net profit that they are using for tax purposes, it might only be 50,000, or it might even be less than that. And you're still applying that same 3x multiplier. So you can see how that would end up being a lot less money. That's a lot less money for the seller, less commission for us. So we want to spend a little time to understand and maximize the profit so we can maximize the price. And we do that with the SDE calculator. Before I go into the calculator, we have to know what numbers we're going to put into the calculator. Okay, how do we know what numbers? Well, the simple term that most people use would be a profit and loss statement. And sometimes that's what you get and it's simple and that's what you use. But I want to show you a list of other potential things that you might see. Also, this list is a tool that you can use. So I'm going to attempt to share. So here we have a document that is business sale documentation checklist. Now, I use this as a template. So whenever I value a new business, I'll just take either this template that's blank, or I'll take the last one that I used and rename it to the new business. This one happens to be for Preamble, the cocktail lounge. Okay, now I'm looking off screen because I got this on a big screen over here, so don't let that throw you off. So business sale documentation checklist, and you can use this to send to the client when you're doing your initial due diligence. In this case, we've already got the listing agreement signed. They wanted to use us to sell it. They kind of already, they're realtors, but they're not business brokers. They had it on LoopNet. LoopNet's not the best for selling businesses. It's better for real estate. And I don't frankly think that they know how to value the business because it's, you know, they said 450,000. We're going to see if that's true or not. We're going to run the numbers right now. But the point of this document is to show you and help you collect. So understand what you need and collect it. And so you can send this to the client, go, here's a list of documents that I need. And if they go like, whoa, that's a whole bunch of stuff, you don't necessarily need, and you probably will never get all of this stuff. If you're working with a very professional business that has a big staff and maybe like on staff bookkeeping and accounting, they're very squared away, they could have all of this stuff. That's a little high level. You'd probably be having some help from me on that sort of thing anyways. So don't get wrapped around the axle, see this list and go, oh my gosh, I have to collect all these things. No, you only need to collect enough to be able to properly value the business. You might need to collect more later to satisfy the buyers. See that, because the buyers are going to have a due diligence process that is going to go beyond our initial process of valuing the business. All right, let's look at the list. So corporate or Schedule C tax returns for the past 2 to 3 years. If the business has been in business that long, they should have those tax returns. Now, if you're in a current tax year, you're probably not, you're not going to have a tax return for that year. Obviously, it's not done yet. The year's not over. You're talking about the year prior. And sometimes, depending on, you know, if you're in the beginning of, say, 2024, they may not have filed 2023 yet. Sometimes businesses don't file on time, they extend. And so the extension deadline is like October. So you may not even have, late in 2024, you may not have a return for 2023 yet. So then you simply go back to 2022, 2021, and so forth. But we would at least need them to give us profit and loss or financial statements for those years if we don't have a tax return. So financial statements for the year to date, which is what I just said, and the past 3 years, including income statements, balance sheet, and cash flow statements. For what we're going to do today, we really are looking at the income statements, and we're creating a cash flow. If they have a legitimate CPA who's good, they can easily produce these reports like this. It should not be a problem. If they don't have a good CPA, or if they're kind of doing it themselves, it can be a little more challenging. Okay. Statement of seller's discretionary earnings, also called adjusted cash flow. So this is what I just described, this SDE calculation. Again, if they have a competent CPA or in-house CPA, ask them for the SDE. Then you don't have to do this work, right? If the business is really complicated with lots of income and expenses, and it's confusing and complicated, we're not trying to be certified public accountants here. We're trying to get a business sold. And just like you would hire an inspector, or your seller would hire an inspector rather, to inspect a home or a building, or the buyer, I should say the buyer, they get inspectors. Realtors don't go inspect the home. There's a lot of due diligence items when you're buying and selling real estate that the agent broker does not do. We hire professionals. So if you're in a situation where you feel like you're really kind of over your head on the financials, and they are serious about selling the business, they're going to need to get a CPA to take a look at the financials and be able to produce these reports for us. And if that's the case, then you've got that SDE kind of done for you. In most of the businesses I've sold, I've gotten some of this first two lines, and then I've done the SDE myself. All right. 3-year trends in sales, expenses, and profits. That's nice, but usually you can just look at the documents that we've already talked about and see the trend. All right. Accounts payable and receivable. This is like future. So if a business has accounts payable, that means they owe for stuff they've already bought. If they have receivables, that means people that owe them for stuff they've already sold. And sometimes that can be a significant amount of money. All right. Current ratio, liquidity ratio, I don't worry about that. Okay, business documentation. So business formation, is it an LLC? Is it in good standing? What state is it formed in? Those sort of things become important. Is it a partnership? How is that partnership working? Licenses, certifications, those can be expensive or valuable if they're transferable. And if they're not, at least we would know, let's say like a liquor license, at least we know that they were able to get one. It's not like close to a school or something. So if you're like, this is a cocktail lounge, it's important to know that they have valid business license and certifications in place so that the buyer is going to be able to do business. Now, a lot of this stuff I'm going to skip over because, again, today we're talking about valuation, not due diligence. So an inventory list is good because, again, asset sale or any sale, if there's a significant amount of inventory. So I listed a liquor store once that had over $100,000 of booze sitting on the shelf, right? So even if they weren't turning up much of a profit, which they weren't, as an asset sale, you had the value of all that liquor, wine, and beer that they had. Somebody's going to pay for that if they're going to buy the business. And we don't know what their inventory is. So they have to give us a list. Similarly, a list of fixtures, furnishes, and equipment. Sometimes I just kind of arm wave that, like, oh, okay, we got a 3,000 square foot daycare here. I just go, what do you think you paid for these things and stuff that are in here? And they might say, well, paid 100,000 or 75,000 or 50,000, whatever it is. And then you have to kind of take a depreciation off of that, maybe 25%, because it's not new stuff anymore. It's like selling stuff on garage sale or Facebook Marketplace. Nobody's going to pay full retail value for the things and stuff that the business has and is used. Okay, asset depreciation. You usually will see a depreciation line item in the profit and loss, and that's what we use right there. But if it's complicated and they give us a schedule, that could be useful. probably that's something, again, that the buyer is going to be a lot more interested in. All right. Equipment leases. Do they own a building or is it leased? If it's leased, that lease is important to us. We want to know what's in that lease and what they're getting themselves. Can they extend it? Business needs a home, right? So that lease is very important. All right, let me just scroll down this list. Okay, non-disclosure agreement. We create that. We have just a boilerplate template, and we just change the name of the company and the dates. And all that does is that gives us something to send to a would-be buyer to sign, saying that they're not going to give that information or talk about it to anybody else for the benefit, the privacy of the business and the owner. But that way, when they sign that, they can receive the calculations and the financial documents that we've gathered. Personal financial statements, and then the purchase agreement. And so these are some stuff in the future. As you collect these from your client, this form is designed to act as a checklist as well, right? So you can send it to them as a list of things you need. You can use it for your own memory's sake, and then you can check it off as you get the stuff. So for example, in this case, we have received financial statements. We haven't received them we've only received year to date, not the past 3 years. So I'll put an X, need other years. I may not need other years because they might not like the price that I come up with. I took a peek at the financials. There's not a lot of profit there. Just at a high level, I'm not sure it's going to justify the price. So if they're not willing to discount, we might be barking up the wrong tree, and either they can find somebody else to try to sell it for a ridiculous price, or they might need to run the business a little longer, a little better, do more marketing, get the profit up, and then they can exit for the price they want. Those are okay things. Okay. Now I'm going to stop the screen share. And I'm going to show you another document that we use, which is a business for sale worksheet. This is kind of like if you've ever seen the MLS data input sheet, it's much more simple than that, but it's kind of acts like a checklist as well. You've got about the business. So, is it established? Is it an asset sale, startup? Okay. What industry? So you could take this to the appointment and fill this out. In this particular business, I was there. I didn't have this form. I just have notes in my phone. But I wanted to show you this so that you can see that you have this little template to follow to give you a checklist to follow so that you're ready to list it when the time comes. Now, asking price, cash flow. Notice that cash flow, that's that SDE. EBITDA, we talked about that. Gross revenue, fixtures, furnitures, and equipment, that's FF&E, and the inventory value. So it's kind of restating the big things that you need. Okay, is the real estate owned or leased? What's the square footage? Any financial notes? Are they willing to sell or finance? That can be a great thing. It's a subject for a separate class, but make sure you ask them. And if you don't have the scripting around seller finance and how to explain that to sellers, again, it's another class that I'll do. Okay, location, this is all self-explanatory. Business is absentee owner, home-based, relocatable, established franchise. What's the difference? So absentee owner means they're in some other city or state. They own it, but they're not in the day-to-day operations of the business. Home-based, self-explanatory. Relocatable, they can move. Established franchise. So franchises, someone else came up with a concept, like let's say McDonald's, one of the biggest franchises in the world, if not the biggest. McDonald's said, hey, we have this concept of making burgers, and it's great, and it works, and you make a lot of money. And if you want one of these, you can pay us and we'll help you set up your McDonald's. So that's what a franchise is. And then these questions here help you to understand some of the key points of marketing. What are what facilities and assets, what support and training would the new owner benefit from? If they're bringing in new people, is there a system and is there training for it? What's their competition? What's the market like for their service or product? What are the growth, expansion, pros and cons, and why are they selling? I call growth and expansion upside. So, for example, hey, we've got a nice cocktail lounge here. It's beautiful. We've got great bartenders. They really know what they're doing. People enjoy coming. There's a customer base that's loyal. However, we're not full. The place isn't completely packed on the busier nights of the week. We're not doing a lot of marketing. So an upside in that case would be do marketing, increase the number of customers, and boom, revenue and profit goes up. That's just a simple explanation for upside. In the case of a daycare we have for sale, they're running at 25 kids and they're licensed for 45, I think. So they get almost double just by bringing on more kids. And there's a reason why the buyer might say, well, why aren't they? And the reason is they're just keeping it low because they don't have time for more work because of a personal situation, which is why they're selling. So that's upside. That's like, hey, new buyer, if you buy this business, here's a few very easy ways to increase your revenue. Most people want to have some upside. They want to see the profit and that SDE calculation, but they also want to see, how do I make this worth more than what I'm paying? Because if I buy a business that's worth 300,000 because it's making 100,000, well, great. But if I want to turn around and sell it, how do I sell it for more than 300,000? I have to find a way to make the business make more than 100,000. If I can make it make 200,000, well, now it's worth 600,000 theoretically. So I just doubled my investment. I could turn around and sell the business for more, or keep it and have better cash flow and return on investment. So that's why I call that upside. Okay, let's stop that screen share. That over there. All right. Stretch and drink some coffee. Okay, financials. Let's do this. First thing I'm going to show you is a year-to-date. Okay, by the way, this is all confidential. It goes without saying, but in your independent contractor agreements, you've already agreed that everything that we talk about within our business is confidential. So I don't have to have a non-disclosure agreement signed by each of you because you're agents here in the company. So you can't share or talk about, you shouldn't talk about anybody's financials without their permission. Anyways, in case you didn't know that. So now you do. All right, let's get into it. Okay, so now you may notice that this says A&R Caliber Investments LLC. The other form said preamble because the doing business as name, DBA, is Preamble Craft Cocktail Lounge or something like that. But their corporate entity, the actual business's name is A&R Caliber Investments LLC. That wouldn't look very good on a sign. Oh, let's go out and party. Let's go to A&R Caliber Investments LLC. That's a great bar. No. Let's go to Preamble Cocktail Lounge. Let's go to Preamble. Cool. All right. So a DBA is often just a nickname for the business that's a little catchier for marketing. Such as Shaw Real Estate is DBA for J. Shaw Realtor LLC, for example. Okay. So here we have dates January to June. So approximately 6 months. Well, it should be all of 6 months. And we have the income and we have expenses. So make this a little bigger. Speaking of bigger, put my blue light blocking glasses on here. Save my eyes. I recommend these. Keep that eye strain down to a minimum. Okay, ordinary income and expense. So we have income from alcohol, other, and then we have some discounts taken off of that. So their total income or top line revenue is this $213,480. Then they have costs of goods sold, also known as COGS. Right here, you see this acronym, COGS, cost of goods sold. Not every business has COGS. Realtors, for example, we don't sell goods, like we don't buy a house and then sell it like an inventory, like a retail situation. We sell a service and we get paid a commission for that service. So we don't have COGS, but a retail business selling products has costs of those products. That shows up here. They have alcohol, they have food, they have their merchant service fees. Every time somebody stripes a car, there's a fee for that. And then they have their restaurant supplies. So the total expenses are there. And then they have gross profit. So people who know how to run bars and restaurants, there's ratios. They're like industry benchmarks. So one of the things they would do is they would look at this and they would know, hey, or they would do the calculation of the percentage of ratio, you might say, of income to gross profit. So the difference is, I'm just doing a little math here. The difference is 56,000 and some change divided by the gross is like 26%. So I don't know. I don't know the benchmarks for bars and restaurants. You don't have to know that, but I'm just giving you a little insight into how a buyer would view this statement. They're going to look at those two numbers, the gross, the total income, the COGS, and the gross profit. We don't really care so much about that. We're going to skip down here to expenses. We want to look and see if there's any of those EBITDA items and anything else that we can add back that might be discretionary. Okay. Bank service charges. Well, I don't pay any bank service charges. Maybe I could add that back. I might want to talk to them and go, hey, what are the bank service charges? Is that something that a new buyer might not have to pay depending on their banking relationship, right? Maybe it's for wire transfer. I don't know what that's for, but it's not a huge amount of money, but every penny counts. Okay. License and permits, those are legit. Computer and internet. Wow, that's a big number for computer and internet. I'm gonna write that down. And I might even do a little division here. So 4584. Now remember, this is 6 months of the year, so divided by 6. They're paying $764 a month for computer and internet. I mean, if they have gig speed and still, I mean, we're about 600, a little over 600 here in this office for, no, it's not even that much. Bigger space, heavier use here. So I don't know. I would ask the owner about that. Dues and subscriptions, meals. Meals are pretty low. You know, probably just how much there really. You can spend 54 bucks on pizza for the crew one night, you know. I don't know. Music and live entertainment. So they do use music and live entertainment as part of their draw. So I wouldn't say that's discretionary. Office supplies, pretty minimal. Payroll. So you want to ask, hey, owner, are you paying yourself a salary? Is your pay showing up in payroll? Yes, I'm paying myself a salary. Okay. Uh, is your job going to be done by someone after you leave? In other words, if the owner is managing, if they're involved in the day-to-day business, they deserve to get paid for that time. And so a new buyer, they either have to do that same job, which means they're going to want to get compensated for that, or they're going to have to hire someone to do that job. So we might want to think, oh, well, the owner's paying themselves a salary. Let's add that back. Not so fast. If that job still has to be done, somebody has to get paid to do it. Now, if they're paying themselves an exorbitant salary, bonuses, things like that, that maybe should be added back. And that's a discussion that you have with the client. All right, rent and repairs, maintenance, tax payments. So I would ask, is that sales tax? Or is it a type of tax that can be added back? That's a question for their accountant. I'm going to assume that it's not avoidable because it's listed in the expenses. So, and then utilities. So total expenses and then net ordinary income. It's another word for profit, NOI. And now down here, they have a little bit of interest income, probably just from money sitting in the savings account. It's very minor. And then you have your net income. So this net income could be called profit. Okay. That is a 6-month statement. Let's look at another one. It is monthly. That's right. Okay, good. So here, this says profit and loss. Okay. But it's a monthly versus year to date or 6 months. So I'm looking to see, we have the same categories. Gross profit. Yeah. Payroll. Yeah. Okay. So now we have net income of $1,276.93. It's like, whoa, look at, made all this money up here and we only got to keep this much. And I don't see much that could be added back in this situation, which is why I mentioned earlier, I'm not sure what we're gonna be able to get done here on price. Let's look at another one. So what I've done is I asked them for these documents. They sent them to me in an email, and I've saved them in a folder called financials that's within that listings folder, so that they're out of my email inbox and into a file. All right. Revenue, pretty similar. Oh, look at the income. Big difference. Over 8,000. So when you see a big jump like this, a buyer's going to ask, what happened this month that, because they want to know, like, is that true or real, or was there some weird income that came in that's not repeatable, or did the business just do really well that month. So that's something you'd want to discuss with the owner. And I'm going to send him a message like, hey, February, you made over $8,600 profit, but January you only made 1,200 something. What's the haps? What had happened was a lot more people came in and drank. No, we don't know. Don't make assumptions. Okay. Stop share. So that was January, February, March. Okay, we got another like $1,000 month, another low month. I was hoping to see another $8,000 month here. We got 1,000. Here, the SDE calculator spreadsheet. Now, we were just looking at the seller financial statements for the business. We were looking at top line revenue or gross sales. We looked at cost of goods sold, and we looked at gross profit. Then we looked at operating expenses, net profit or net operating income, aka. And now we're looking at, okay, what is EBITDA? And then we're going to look at SDE that I described earlier. Okay, so this is showing $213,480. COGS is 56 plus. OPEX, operating expenses 131 plus. All right. Now we only have 1 year, 2024, which isn't even a complete year of financials. I just copied across these other years the same numbers. The spreadsheet that this flows over to is set up to show 3 years. So rather than having empty boxes, and that's going to cause me to have a bunch of missing reference errors on the front page, I just copied them over, just kind of keep it, at least for now, looking good. If I decide to delete columns and stuff, I can do that later. So it's just easier for me to input the 2024 numbers and copy those across. Okay, speaking of 2024 numbers, let's bring those back up. I just want to peek at them real quick. Okay, so interesting. Some of y'all may have caught this already. What is wrong with this spreadsheet? Let me go back and share the January through June 2024 income statement or profit and loss statement. And those numbers are showing up in my spreadsheet, but this is 6 months. It's not a whole year. Okay, it's not a year yet. So here's what I need to do. I need to go back to my spreadsheet. We're back on the spreadsheet. So what I could do is times, oops, that's not what I meant to do. Click this and click equals and times 2. And now I have a annual figure. Drag that over. Oh, no. Yeah, I don't want to times that. Just want it to be the same number. I can drag down and just copy that formula, so it'll times 2 this income. We'll just drag that down, times 2 that. Okay, so now 2023 is saying what it would have said if they did what they're doing in 2024. And the seller has told me, he goes, yeah, last year was about the same. So I don't have last year. I only have 6 months of 2024. But he has told me, hey, yeah, this is an accurate representation of not only this year, but last year. He doesn't know about 2022 because he didn't own the business at that time, but I am going to ask for financials for that year as well. So I already know this is not going to be highly accurate. That's okay. I'm trying to just get a starting point for understanding the value of this business. And I can get it up online. I can get it marketed for sale without having all the data. And I can start generating leads and phone calls. And yes, some of those people, if they call me 5 minutes after I make the listing active, I'm not going to be able to answer every single one of their questions. That's okay. I want that phone call. I want them to call me before they call the next business for sale, because you know what I could do? I can go, hey, hey, Matt, I got a hot one, but I need some more questions answered. Then he's going to be motivated. Him and his partner and their CPA are going to, hopefully rise to the occasion and get us some better data. I can put the buyer and seller together on a phone call and we can start having question and answer. That might surprise you, because in residential, we're always doing this arm's length transaction, keeping buyer and seller separate. But there's so much I don't know about this business that I would have to get buyer and seller on the phone. All right, now I need to do the same thing here to duplicate. So I'm gonna I could just copy that formula. See, I'm not copying the result in that. I'm not copying this number. I'm copying that formula. All right, and then I can just drag that down, and formula's good to go. And then I can just copy that, paste that in there, drag that down. All right. So this is 2024. I'm just going to make a little year to Jan to June, just so I know, and anybody that looks at this would see that that's 6 months. Okay. EBITDA. Let me just double check all these formulas are doing what they're supposed to do. So it's supposed to be subtracting these, and it's supposed to be subtracting that. There aren't any other expenses, so that's going to be correct. Probably just put a 0 in there just for cleanliness. Okay, EBITDA. Remember, we talked about this is, I'm going to zoom in on that, earnings before interest, tax, depreciation, amortization. Here we have interest expense, which, did we have any interest expense? I don't think we did. Flip back over real quick and look. Don't see any interest expense. Real property taxes, they don't own it, they don't have any. Depreciation, amortization, I didn't see any of those on their financials. If they've had those things, if they, then they didn't tell me, well, that's a problem. And that'll have to come out in the wash later. That'll have to come out in further discussion. And there were no income taxes also. So these numbers just drop down here. So we are showing a net income of about 70,000 a year. Why is this one different? It should be the same. Oh, well, because I need to take out interest expense because there wasn't any. Okay, now you notice this number went down because these columns are designed to be added back to this. So if they were paying interest of, say, 10,000 a year, it would increase. Remember, we're adding back to get EBITDA or to get SDE. We're looking for things to add back to the profit, to the net profit. If they had depreciated a piece of equipment, $50,000 worth of depreciation that year, right? See, this net income starts going up. So this would be EBITDA in this case, but it's not. So we're taking those out. Okay, so we got 50K a year, a little over. This is half of the year. Now, how do we get SDE? Jay, you said we don't use EBITDA, we use SDE. Okay, right over here, I've got a little nifty spreadsheet that allows us to enter. So they don't have a storage building. The last business I used to use this spreadsheet with They were paying storage. I said, hey, do you guys need this storage building? They said, no, we don't need that. We don't have to have that. So we would just zero that out. In that case, I put it in there to add it back. In that case, the owner was paying for some healthcare expenses that were not technically needed by the business. There was some miscellaneous, is that generator I was talking about, right? Part of that 14,000 was a generator. Okay. This business has a little bit of meals. What was it? Meals, $54, but that was 6 months. So, okay, I need to fix my years here. What are the years again? Time flies. 22, 23, 24. So 2, 3, 4. So we got 53 in meals. This would be 106. 106. Travel. Did they have travel? I didn't see travel. Nope. No travel. No auto. I already remember I didn't see any auto. Pay cash. No charity. They don't give any money to anybody. I'm kidding. I'm sure they do charity. It just doesn't reflect in their expenses. I didn't see any one-time repair expenses. They do have professional fees. What was it? Maybe I'm wrong. I thought I saw professional fees. Oh, I don't see them. Okay. Professional fees are things like lawyer, tax, accountant, strategist. Now you could say, well, Jay, wouldn't any business need those things? Maybe, I don't know. Maybe they had to defend a lawsuit one year and they spent $20,000 to $50,000. That doesn't happen every year. If they have ongoing legal expense for any given business, and you ask the owner, well, I see these professional fees, is that something? They might say, well, yeah, no, that was we had to do an audit, so we had to pay the CPA extra money that year. Okay, cool. Let's add that back. One-time repairs, expenses, that'd be like, well, we had to fix the roof. It was a big, $20,000 roof repair. That doesn't happen every year. So, okay, late fees, I didn't see any of those. I did see bank fees, but that's different. So do I have a category? Yeah, and if you have anything that doesn't show up in these categories, just add it or change a category. Like you could just take this and instead of late fees, you could say bank fees. And what was it? It was just saw it. Bank service charges, $393. So this would be 393 times. Here, just 786. Okay. So that is all we can really add back. There's not much in this case, sadly. So we go over to our page over here. Again, we need to update our years. Let's just do this. That equal. Just notice that typed. It's okay. I love spreadsheets. They do so much work for you, but It's like any computer operation, garbage in, garbage out. So you have to check your work. And even this tab is named. All right. Again, hypothetical numbers. We don't know exactly what they were in 23 and 22. We only know half of 24, but we're doing the best we can to help the seller. So here we go. Gross sales for the 6 months is this. Now I could, if I wanted to, I could take 2024 and double that like a pro forma, and maybe I will. We're getting close to the end of the year. But right now I just kind of want to go off of actuals. So here we have gross sales. I'm gonna look at 2023 because assuming it's a full year, reasonably accurate. COGS, gross profit is sales minus COGS, expenses, and net profit. And then adjusted cash flow. So we talked about SDE, aka adjusted cash flow. Some accountant type people may not recognize SDE, but they would recognize adjusted cash flow. And you can see there's about $900 addition. It's not a lot, but every little bit helps. Here I have the spreadsheet give me averages, annual averages, which is going to be a little skewed because again, this is half a year. That would be one benefit of going ahead and making a full year, even if it's pro forma. Average net profit, average owner benefit. So I call this owner benefit. It's taking the average of the adjusted cash flow and sticking it in there. And that, so I'm starting to make that transition from accounting terms to, hey, sales terms. Buy this business, and as the owner, you get this every year, owner benefit. All right. So let's get there's right. I must not have updated all that last time because I sold the last time I used this was 2024. So I guess I failed to update all those years. All right, so first for the full year of 2023, here we go, the SDE right here. And that should match a little bit of a check and balance here. That should match this up here. 26,452, 26,452. Okay. And so what this is doing, what these spreadsheets down here are doing, are they are referencing. If I double tap that and click that, it takes me over to here, our SDE calculation. So let me get out of that and go back over there and just double check that my, oh look, charity is missing. So let me, it's an easy fix. Oh, an owner salary is missing. Let me just fix that. It's not going to change the numbers, but I'm just making my spreadsheet correct. Back over here, make sure I don't have any red flags. Oh, I got dates. And apparently at one point I had 4 years of financials. Okay, let's get rid of Juanitos. All right, SDE calculation is done. I'm going to stop the share, and now I'm going to go into the interwebs. And here we are in Biz Buy Sell. I'm going to spare you the whole logging in and all that crap, but essentially it's bizbuysell.com. When you have the opportunity to do this, you will either have my login or you'll have your own account. The cool thing about Biz Buy Sell is you can create a free account and start getting in there and looking at stuff. You only have to pay when you have an active, when you want to do a valuation or when you have an active listing. So this is the page where we value a business. We're going to click, notice establish business, asset sale. We talked about that. That's when there's no profit. Business real estate for sale, business real estate for lease, startup opportunity. So this is not an asset sale. They are profitable. We're going to say established. Industry. Let's see if bar is industry. Bars, pubs, taverns. Okay, headline. Sexy lounge. I'm just gonna say craft cocktail lounge for now. And let's say growing area. That's changeable later. We don't have confidentiality so much on this one. And so yeah, it's only just my phone. The address, I do not have it memorized. 2801. Golf. If it finds it, it will. I say I-45. Oh, well, that probably is why I stuck an extra number in there. Garbage in, garbage out. There we go. Full location. Uh-oh. It's making me refresh, probably because I started this yesterday and now I'm starting it again. So I'm gonna have to redo that probably. Isn't that a bummer? Yeah. Okay, so well, I guess you get to see the whole thing. So dashboard, my listings, blah blah blah. Going into sell a business, value a business, and you can do a quick estimate over here, by the way, and that's I think it's free ballpark. Yeah, it's free. We're gonna do this is for people who aren't brokers like us. This is a lead generation piece for Biz Buy Sell. So we want to hit the middle of this valuation report. And it's going to tell us the pricing ranges from 20 to 60 bucks. See, in this page, they don't really have a bar. I'm just going to pick retail and then bar. And of course, it's going to charge us the full fee of 60 bucks. Find this. Maybe it'll get cheaper. it did refine the number of results, but it didn't get any cheaper. Even though it says price depends on total number of. Yeah, I haven't seen one for 20 bucks ever, so I think that's a bit of a misnomer. So here is our, this is just a really high level average. Okay. So we want to start populating some fields. This is where you might recognize this like a CMA on a house. But instead of square footage of bedrooms, it's money. Okay, so gross revenue was, I'm gonna put 50, no, sorry, 400,000 to 500,000. Cash flow, that's that same thing as the SDE. I'm gonna say between 40,000 to 60,000. I'm not gonna put a sale or asking price. I wanna say within the last year, hopefully I find some. And Texas and update. 0 businesses. Okay, so let's try all regions. 0. So it's not the location that's the problem with updates. 3 businesses. Sold 2017. That's a pretty long time ago. However, the industry multiplier doesn't change all that often. So what I want to do is I'm going to put in gross revenue over here of 0.26960. So median multiplier on gross revenue 0.32. I'm going to put in our 52,905. I'm just rounding off. And here we go. 3.11 is the, so what this shows is cash flow median multiplier. We calculate a multiplier for each business with a cash flow value in the report. Then we take the median to derive a multiplier. For recently sold businesses, the multiplier is calculated by taking the sale price of a business divided by its annual cash flow. So they give us this ratio based on comps. So by cash flow, and this is why it's so important to do this calculation. Because look, what's the highest valuation on the board here? The one by cash flow. All right. So, but I would like to have more comps, more recent comps. So what if I took away these amounts? Okay, 14, and looks like almost all of them are in Texas. So it shouldn't change much if I do that. Good. Okay, 2023. All right, so we've got some old ones and some new ones. So let's go shoots, last 3 months. Why not? Let's see what happens. Nothing. Nothing. Okay, last year. So we're gonna have some that are beyond a year, but not like 5 or 10 years too late. So these little boxes here, similar to the MLS, we can take away if we want to. So El Paso sold in 2015. That's Round Rock's not that far away. Maybe I'll keep Round Rock. So I'm just gonna look, okay, the ones that are nowhere near and a long time ago. I'm just simply, oh, here's one in the Houston area that had cash flow of 60,000, but it sold 14 years ago. I'm gonna think about that. Had a moment of panic, taking my earpods out. I thought, God, did I unmute myself on this Zoom, or have I been talking this whole time? Without it being captured. It's so nerve-wracking sometimes filming these videos. One little thing goes wrong and there's no more video. All right. Austin nightclub 08. Nah, that's comparable. 06. No. Okay. Let's remove those. Okay. Wow. Our valuation went down. It's not good. The Wet Leprechaun Tavern. This will be interesting. The names here. Too good here because the seller, they want to sell this for $450,000. So I'm seeing a problem. Okay. And this happens sometimes. Just like with buildings and houses, sometimes the sellers have a notion of what they think it's worth that might not be in touch with reality, let's say. But I'm not giving up yet. Let me take out cash flow. Now, I know I said a minute ago that cash flow is the best way to get the value, but I just want to see what happens if I take that out. Not much. The median multiplier went down. I'm going to put 60,000. You would think bars would be more profitable. When I put that cash flow number in there, the median multiplier is that 3. The cash flow was 100,000. Goes down. If it was 1,000,000. Oh, as you were. This is changing the comps, not the take that out just for fun. Okay. That. So pretty much no matter what I do, the multiplier is either 2, or if I put in our cash flow range, which adjusts the comps, it jumps it up to 3. So that means there's some comps in here that sold for a much higher revenue. So let's look at this one. Brand new bar in Northwest Houston, sold this year, just a few months ago. Gross revenue 400,000. That's pretty close to our gross revenue. Let's look at that one. Let's look at that one. Oh, pop-up window blocked. Why? Okay, here we go. Brand new bar, Northwest Houston, Harris County, sold. Didn't have an SDE or EBITDA. Sold price 70,000, asking 100. Wow. Gross revenue 400,000, inventory 4,500. 10 employees. No specific information about what it was. But look at that. Gross revenue 400. Ours is just a little over that. Sold for $70,000. Rats. It opened that 3 times. I'm gonna get rid of that and go back here. Did anything, okay, so let's look at something that sold for a high price, if there is one. Sold for 300,000. Neighborhood bar in San Antonio. Gross revenue 700. Didn't have a cash flow on there. Neighborhood bar on Loop 410. Not much information. Per normal. I take that away and I want to sales price 450. Let me do 300 to 500. What I'm doing here is I'm looking to see what businesses sold in that price range and what was their revenue. What were they? So here we go. Got a bunch in that sales price. They sold a variety of years, but some of them quite recently, and gross revenue over $1 million. Cash flow just under $200,000. If they were doing those kind of numbers, they could command that kind of price, but they're not, and they probably can't. So now the mission is we're not going to give up. I'm going to go in here and put in the real. As a matter of fact, I might, and one of the good things about this is because you've paid for it, you can print this report multiple ways. So I want to take this one because it's showing the asking price range that they wanted. And it shows what the revenues and cash flows are for those businesses. And so I'm going to print that report as evidence that's going to back up. Let's not say back up, it's going to educate them. All right. Okay, George. My computer may work a little different than yours. So I don't want to spend a bunch of time. Okay, when I hit print, it just sort of opened it in a new window. So I'm going to do it a different way. So you can't see it, but here over on my other screen, it's created a PDF of that report. Although, that one has a bunch of sort of like old stuff on there. So I could go in here real quick and I wish it had more filters for like 1 year, 2 year, 3 year, so forth, because it only goes out to a year. And so you just have to sort of manually narrow it down sometimes. Probably sort by year and make it a little easier. because they would all be together, but it looks like it's actually, I think it's already done that for it. Yeah, it actually has. It's displaying by default chronological. So I'm going to keep the top ones and remove the rest. And here's my report on what it would look like to have a business worth 450,000. All right, I'm going to go print, and I'm going to make a PDF. And I'm going to take that, I'm going to save that in that client's folder on my computer so that I can send it to them later. Then I'm going to go in here and change this. I want to take out the asking price and put in the cash flow. That's really what people care most about, even though you see businesses in there that didn't have cash flow listed and sold. Guaranteed in that conversation between buyer and seller or the agents, one of the first questions is, okay, yeah, I see 400,000 revenue. What's the profit? So though they may not have advertised the profit, it's still important. Okay, update. Okay, unfortunately, every time you change criteria over here and you hit update, it brings those old ones back. So I'm gonna have to get rid of those again. So I'm gonna print this because I'm here. I'm gonna save this, but there's something wrong with this. Because over here in this, I've got these two little boxes where I can adjust these numbers up here. And over here, I think because of the fact that I told it to print, it took that away. So again, this criteria over here controls the comps. This criteria here gives you the price and multiplier for a given revenue or cash flow. So they kind of work together, but different. So again, I'm going to take away the 3 to 500 and I'm going to put cash flow. I'm just going approximately $10,000 plus or minus on cash flow, kind of like we do 250 square feet plus or minus, 10 years to your build plus or minus, same concept. I already know I'm gonna have to put all dates because if I don't, we're not gonna get any results. Okay, and it took away the old ones. That 52 SDE calculator got covered up. Okay, SDE calculator helps to have two screens because I'm toggling back and forth between my calculations and this site. So 52905. Or you can write your key numbers down on a notepad and just have it in front of you if you only have one screen. There. So valuation by cash flow, 117 and change. 180. So in this set of comps, we've got a better valuation on gross. Maybe that's why a lot of these businesses were listed without the cash flow. They were listed with gross revenue. But nevertheless, I am going to print this one. Not print, but save it as a PDF. Almost done. Hang in there with me. And then I'm going to take the comps based on gross revenue. Invalid range. Oh, I forgot a 0. Okay, here we go again. We got a bunch of old ones that show up, but there's always annoying things about tools. Software is just a tool, and this is one of the annoying things about this tool. It's weird that it brings up so many more on revenue. And I think probably another reason for that is people often, ooh, almost delete that one, but that's 2024, so I don't want to delete that one. I don't want it was sorted like that. I think it's because people don't really know what their cash flow is. They don't do the calculation. So people can sell their own business in here. It's not always brokers, and even if it's a broker, they may not be that competent, and they may just not take the time to calculate the cash flow like we did. And or they may just want to advertise it on gross revenue because it looks better. So when we do that, it spits out these numbers. So it's a little bit better this way. So what this is telling me is like, okay, I should advertise this business based on gross revenue. I know what the profit is. I'm going to have to sell around that. When I get people calling me, I'm going to have to really pump up the fact that this is a beautiful location. It's got a wonderful build out. It's got the sound, the lighting, the stage. It's got great bartenders. It's got a loyal customer base, and just need to grow that customer base, and then it will be worth twice as much basically. So every dollar, this multiplier on cash flow is nearly 3. Right here in this view, we got it at 2.4. So it's between low 2 and low 3x. That tells us that every dollar of cash flow that an owner could create in this business would give them a return of 2 to 3x. So that's good news. Just this owner hasn't done that, so they can't sell it for that. But we're going to try. We're going to educate them at this point. Let me go ahead and, before I forget, let me print this. Okay. So what I've got, let me, in that screen share, and come over here and share. Bear with me while I shuffle these documents around a bit. It's not very complicated. I hope you feel like it's something you could do on your own. I find this to be, in some ways, simpler than doing a market analysis on a house. Once you kind of get your head wrapped around the financial terms, the bookkeeping terms, EBITDA, SDE, cash flow, profit, all these new terms, once you kind of get that absorbed and you see a few sets of profit and loss statements or whatever they give you and stick it into the SDE calculator a few times, it starts becoming easier to understand. All right. So what I would do at this point is I would share these different documents. So, oh wow, is it showing multiple documents at once? It is. It's kind of cool. So in this one, they would see 11 businesses used and by average sale and asking price, by gross revenue, by cash flow. So this is the one where we I think we put the $1 million, or sorry, we put in the 400 or 300 to 500,000 gross revenue, and we saw that you need to be making or sorry, sales price, the 400 to 500,000 sales price is what we did on this one, and that we need to be making $1 million gross and 1 to 200,000 net. This one here, I wish it showed the criteria a little better, but I'm not even sure if this one makes sense to show them. Average sale. Oh, I think this is when I had the comps for, yeah, that one doesn't make sense. So again, be thinking critically about your data. Okay, yeah, let me go back to that one just to show you what I mean. Oh, I'm not sure. Anyways, that one's broken. I'm not sure what happened there. So comps are recent, comparable, by cash flow, by revenue. This one is probably my favorite. I think it has the best group of comps, got a lot of comps. So I'm thinking, okay, I'm the seller and I'm about to look at this report. What is it going to say to me? What am I as a broker going to say about it? Now, one thing about I don't like it, Best Buy Sell kind of throws these little graphics sometimes pop up in it wrong place. It's it's not ideal, but I don't know how to fix it. It's just a glitch. Maybe it won't happen on your computer. But yeah, they can see the comps. They can see with their own eyes that real businesses, just like theirs, with revenue similar to theirs, sold for these prices. Okay. And then that information is kind of summarized with averages up here, and then their actual cash flow here, which would result in this valuation here. Okay, average of all the comps, average by gross revenue, by cash flow. That is valuing a business. Now, I won't talk about next steps too much, but this is the point at which I would start creating an email to give the feedback to the seller. And if it's, I mean, this is pretty far off. They're thinking 450. The listing agreement says 450, I think, or it says to be determined. Either way, when we show them this, they're either going to go, oh, wow, oh my gosh, like, no way, I would never sell for that much. Or they might go, well, gosh, yeah, well, because they may know that they're kind of swinging for the fences on that price. They may be fed up with the business and ready to be done. And if that's the case, they need to be much more realistic. Now, if they say, well, Jay, I wouldn't sell for that low, but could we try to get 2 or 250? Sure, let's try. But we just need to know that there's got to be a conversation about that, and it may blow up the deal, and that's fine. We're going to lose that time, but at least we don't lose more time by going forward, putting it on the market, pictures, videos, spending thousands of dollars of marketing collateral and our time to sell something that is never going to sell for what the seller expects. In that case, it's much better that they just keep the business, keep doing what they're doing, grow the revenue, get it to a point to where it makes sense. And then maybe they come back to us and they go, hey, guess what? We're making 200K net profit a year. We want you to sell this thing. And we go, great. And maybe by that time the market's improved and we get $500,000 for it. I don't know. But that's how this works. I hope that was helpful. Again, a lot of information, much of it you've probably are hearing for the first time. That's why I recorded it, so you can go back and look at it again. It's got examples. Oh, let me stop the share so I can just talk to you real. So I didn't get this first time I did it. That's the case with everything in real estate. Everything I've ever done in real estate, I had to practice, I had to learn. It doesn't just stick first time. But the more you practice, you get some reps in, it starts to get easier and easier until it rolls off the tongue, until you can go in here and do what I just did without instruction or step-by-step guide. You just know it. So be patient with yourself, ask for help, and let's sell some businesses.